All right. Hey, everyone. Welcome to Investment Tuesday. Okay, this week's issue of Investment Tuesday is packed. So I want to get to everything that I have planned and laid out. It is a extensive agenda. First, we will start with Friday's market action, and I'll focus mostly on stocks. I'll talk briefly about crypto. I'll make some comments about crypto and tell you, is this the end? Is it all over? I'll cover that part. Next, we're going to talk about, okay, so the market sold off, is going to keep selling off. What's going to happen? We'll cover that. And then what should you, go into? What, based on investment logic, right? Not based on what's popular in social media, what makes sense. We'll go into, three sectors. And then I want to cover Fannie Mae and Freddie Mac because there was a tweet from President Trump this weekend throwing out the big T, $1 trillion mark, he says, for Fannie Mae and Freddie Mac. So we'll just cover that pretty quickly, and we'll aim to try and get all this in 30 minutes. If we don't, well, you can scroll through. All right. Well, let's start with the things that keep our lawyers happy, which is that this video and the content from ATG Digital is not investment or financial advice. It is presented to you as my opinion, our view, our take on the world. You use it as information, engagement, or entertainment, whatever you choose to do with it. It is your responsibility because it is your money. All ATG Digital content may contain errors, oversights, or mistakes. Understand that investment operations have significant risks and can lead to the loss of your principal. Bottom line, you're not guaranteed to make money. You could lose money. Next, the owners, employees, contractors of ATG Digital, we own, trade, transact the securities that are mentioned in this video and all content from ATG Digital. We do not take money from companies or crypto sponsors, promoters, etc., to recommend their stocks or crypto tokens. We publish an extraordinary amount of free research, starting with our Substack, which goes out every market day, the Ballman Speculating podcast on Spotify, which goes out about once a month, and YouTube, where I'm on pretty much every week, along with my colleagues, Dean and Dan, who are on about, I think, every 2 to 3 weeks or so. Social media, I am quite active on X. We are reasonably active on Instagram and Facebook. Want more of what you see on a regular basis on the free part of the YouTube channel? Well, then you can join the Paul Mampilli channel here. And what do you get? Well, you get early exclusive access to the Investment Tuesday videos. And then we are making exclusive videos, which go out only to members that focus on particular stocks or investment opportunities, crypto. Maybe even from time to time, we'll throw out an options opportunity that just looks particularly good, where we can go and give you a little bit more analysis. In the same vein, if you want more of what we provide, you can also go to atgdigital.media. It is critical you go to only that website, not a website that has my picture or looks like this. You got to go to that website, and you can select from, what subscription you would like. We have silver, gold, platinum, diamond, and purple tier. Pick what's right for you, and you can again get more of what you get on a free basis from our YouTube channel. All right, I will take this down, and let's get going on all of the analysis that we have to show you. I need to reconnect my share screen here. And let us start with what the market has done after Friday's move. So this is a chart of the Russell 2000, the S&P 500 cap weighted, meaning the biggest companies hold the biggest weight. Then we've got the NASDAQ composite. That's all the companies that trade on the NASDAQ stock exchange. Remember, there's two exchanges, major exchanges in the United States, the NASDAQ and the New York Stock Exchange. All the big tech companies trade on the NASDAQ. Then we've got, looking the fine print, the S&P 500 equal weight. Remember, there's two versions, right? Equal weight means every company, however small, gets an equal weight. And if it's, bigger companies, then, well, all those multi-trillion-dollar tech companies, they have the biggest weight. And there is a reason to track both of these, which is that we have extraordinary concentration today in the S&P 500 and also in the NASDAQ 100, which is the black line, which is, I think, 40% of the S&P 500 is in the top 10 stocks, which is a record, and nearly 70% of the NASDAQ 100 is in 10 stocks, which is, it's a galactic record. We've never seen anything like it. So you can see here what's the damage, if you will, as a result of what in social media is being, put on or blamed on a tweet post from President Trump about tariffs. And I see analysis talking about, oh, well, there was a big misunderstanding. And I think that's all besides the point, truthfully. The reason why, markets reacted the way they did, and crypto reacted in the same way, really, it's always, a function of market position. Like, how is the market position going into it? And let's go into some analysis and look at how the market was positioned going into this, tariff storm, if you will, which is margin debt was, well over $1 trillion, right? It hit another record. In other words, we are levered to the gills. We meaning who? Well, margin debt is generally taken on by retail investors, individual investors. What drives it was generally success. In other words, hey, all my positions are going up. More is better. My broker will lend me money against my positions. Let me borrow money and buy some more stock, use some more call options, etc. So we are positioned, the way the markets are positioned is that leverage is very high, expectations are very high. And from my perspective, remember, I've been 30 years in the market. People always focused on the news. I look at, what's the position of the market. I can tell you that without this leverage, right, assuming we don't have $1 trillion, let's say, let me go to the chart here, and let's just say, we are here, or, even somewhere here. Markets really don't react to that. Why? Well, because they don't have those expectations. They haven't discounted that the world is going to be milk and honey, and a bed of roses for, forever. Next, also in the realm of position, which I've brought this up before, which is this NAIM exposure index, which is a measure of active investment managers and how they are positioned. Now, while we are not at the top record here, we're generally in very, very high territory. If I scroll this out here, generally you'll just see, these are, post-crash kind of like bottoms. You can see this is the Liberation Day low. Let me take this back to 5 years again. So yeah, Liberation Day exposure, 35, and then we've gotten as high as 99, and we've been there in that territory. I don't believe this accounts for the Friday. No, it doesn't. It says October 8th. So it doesn't account for what happened on Friday, but generally exposures are high by professional managers. And this has been the setup. Post-Liberation Day, professional managers were obviously they sold out. So it's taken them a little bit of time to jump back into the market. They got to compete. Remember, investment management is an annual performance game. What you deliver in performance by December 31st of every year dictates your bonus, dictates your promotions, and most importantly, dictates your performance fee. So if you can't perform by that date, yeah, you're going to lose clients. You're probably going to get fired or demoted or whatever. So yeah, all of the analysis can say one thing, but if the markets are moving higher, you got to play. You got to play. You got to put your money in. You got to push your chips in and play. So we are generally in a position where, retail investors, highly leveraged, very excited, euphoric about the market. Professional managers are aware of the leverage. They're aware that, valuation levels, which I'll get to, are very high, et cetera. And they're reluctantly going to the market because they got to play. They don't want to lose their clients. They don't want to lose their performance fee. All right. So, okay, we talked about valuation levels, and let's get to that. Let me make this a tiny bit bigger. Charles Bailello really puts out very good stuff. If you are on X, I really recommend following him. And so here is the Warren Buffett indicator, if you will, which measures the total market value, market capitalization of stocks relative to GDP. And you can see we are well in record territory, right? I mean, we are 217%, right? 217%. So the value of the stock market, across all companies, but, with the concentration today, that's not really saying like the entire stock market, because in my opinion, this is a bifurcated market. Bifurcated meaning it's split into two. There are the very big tech companies. There's the AI mania bubble, whatever you want to call it. And then there's everything else. And this is very much a reflection really of like the tech stocks and the AI mania. All right. I mean, that's what has blown this out to these levels. So valuation levels are very high. This is not, among professional investors, this is not some secret, right? But like I told you, even though that's, normally a cautionary sign, and very long-term investors, Warren Buffett, for example, Warren Buffett has, I don't know what, 315 billion in T-bills, and other people like, Oakwood, I forget his name, it's not coming to mind. They're all like, hey, listen, valuations are very high based on, history, analysis, research, evidence, experience. Yeah, generally long-term, it's a bad deal to buy when, the big indices reflect this. Let's also go to positioning back again, which is that, I mean, being that for the last 6 months or so, and I don't have this post up, it's very clear data that shows that retail investors are really in charge of the market. They're the ones setting prices. They're the ones sort of like pushing stocks, higher, using, again, leverage, as I showed you, but also call options. So, I mean, option volumes, call option volumes in particular are at like nosebleed levels. You'll see on the lower part of this here, it looks at call volumes. They're very high, and in general, option volumes are very high across the board. So once again, positioning is the reason why you're having this volatility. I mean, if we had everybody positioned, betting on lower prices, you would have actually seen the stock market go up. But we have had for 6 months. You know what? Let me get that particular post up because it is useful to have. Yeah, there we go. Let me quickly share this. Yeah, so you can see it is retail investors that are very much in charge of this rally. And from having been in markets for 30 plus years, yeah, you can see, that every major top is associated with, retail buying, very rapid retail buying, a lot of leverage, a lot of calls, all of the above. So that's where things stand on that basis. All right, back to valuations again. Just using things that professionals use, which is that most retail investors simply look at the stock price. So $100, let's just say, is high and $5 is low. Professional investors look at things like valuations relative to earnings, relative to sales, relative to cash flows. And then you can compare it to history, because while history doesn't perfectly repeat itself, the patterns repeat, right? I mean, generally when you're paying very high, these are called multiples of earnings, multiples of sales, multiples of cash flow. When you're paying a lot for something, in other words, if I pay, $25,000 for this shirt, well, I mean, let's say I used the shirt 10 times, I've gotten $2,500 worth of utility each time, versus if I paid, $100 for this shirt. And if I use it 10 times, well, hey, I got a much better deal. So that same basic analysis applies to the markets. If you're paying a lot of money for your stocks in terms of valuation, generally long-term, bad things tend to happen. I mean, that's what, all of these charts tend to point to. Okay. From here, and I know I am moving fast because we're already at the 15-minute mark and we still got a lot to go. All right. So what do you do here? What do you do here? The momentum trade is definitely in tech. The momentum trade is definitely in AI. And, people are desperate to buy those. Why? Well, they've gone up so much and everybody else is in it and everybody else is making money. At ATG, we focus on investor psychology. I will tell you that maybe in the short term, for very deft traders that can, move between positions and trade and I don't know, they all got out on Thursday or they got out, on at 9:30 a.m. on Friday magically somehow. Maybe for those folks, the momentum trade is where you want to be. In our opinion, what we see with the big tech stocks, with the AI mania, and also with what I'll call, highly speculative stocks that have been driven very much by social media action, which are, now as a general called meme stocks. In other words, a stock with a very low stock price that has just been smashed to the ground. People are organizing themselves on social media and collectively buying it. In the process, they're, shooting these stocks higher. Those kinds of things, we would say, I'd avoid it. I'd also add to that all the super hype sectors. Again, this is my opinion. I know there's people who will be like, Paul, you're crazy. You don't know anything. You're an idiot. You're a fool. That's all fine. The very hype sectors, what are they? Quantum computing. Why? Well, listen, there are no quantum computers. All right. This is a research field. The valuations of these stocks are driven by, hype, mania, whatever you want to call it. Nuclear technology is another one. What are the others that I can think of? Those are like the big places that, because nuclear technology is closely associated with the AI mania. In other words, people are like, hey, they're sounding a theme that we've told you about, which is that AI is going to require an extraordinary amount of energy, right? I think ChatGPT, OpenAI claims that they're going to put up a AI server farm that's going to require 10 gigawatts of energy, right? The biggest nuclear plant that we have does 5 gigawatts, I believe, right? And the total amount that we produce in nuclear energy is 97 gigawatts. What the thing that, that makes, all of this like hype is that there is a vast chasm between what the stock market is currently pricing and how long it takes to, get any energy source into the ground. A nuclear plant will take 7 to 10 years, right? Before, you ever see anything. To have it commissioned by itself might take 3 to 5 years. So there is stock market time, which is what all these speculative sectors are based on. In other words, high excitement, high mania, very high emotion, and people very focused on the momentum of the stock price. And then, somebody like me is like, well, longer term, that's driven purely by demand without a business case. And history says that demand runs out. And then you don't want to be on the other side of that. And we had plenty of that, in 1999, 2000, around the internet, around, the human genome had been just sequenced, and people expected, every biotech company to cure every disease on earth within the next year or two. Obviously, that didn't pan out. So the market has a long history of getting very excited about many things. And then when disappointment sets in, these prices fall to earth. All right. Where would we be? Yeah, right. Where is there an investment case for this? And, I predicate this on the idea that we are in a two market scenario. There is the tech and the various manias, and then there is everything else, which mostly people are not interested in. They just don't care, right? It doesn't excite people, right? So for our money, in our opinion, energy is a place that we would focus on. So let's get started on, again, some analysis rather than emotion. And here's the case for energy, right? Okay, the AI case for energy, most people sort of by now have heard of, like, which is we need an extraordinary amount of electricity, which has to in somehow be generated by some energy source, right? And the part that's less thought of is that for the last, I'll say, 20 years or so, certainly Western economies, I'll set China aside, Western economies, United States, Western Europe, and even Japan, have had a conservation mindset. In other words, we don't need to explore for, I'll call, conventional forms of energy, oil, natural gas, coal. These things are dirty. These things cause destruction to the environment, and we will simply not participate in this, right? And that has gone on for multiple decades, multiple decades. Well, quietly, what's been happening in the background is that it turns out that a lot of these analyses were really driven by, I guess, a idealistic bent, a ideological perspective, and they shaded the actual truth from us. In other words, as this thing says, which is that the IEA, which is the International Energy Association, supposedly the global body that, has all the data, all the information, and whose forecasts should have some, some bearing on reality. Well, it turns out that they are completely flipping the script. And now they are telling us, after, remember, 20 plus years of telling us, yeah, oil, we don't need that. That's going to go to zero. And, hey, like we own Tesla, and EVs will slowly over time take over, but it's not going to happen in a week or a month or a year or even a decade. This will be a multi-decade transition. And in the meantime, we've got the population of the earth that, their first car is still likely to be something that takes some form of gasoline, diesel, whatever it is. So now it turns out that the IEA and all of the, the energy, organizations, I'll call the energy elite of the world, they flipped the script. They're now telling us that, read this, the tweet here, which is that the world needs all forms of energy with total energy demand expected to grow. Remember, this is going from like negative by like a significant number to a 24. In other words, they're talking about like a complete reversal in a sector where, to find oil, you can't just stick a metal straw in the ground and find oil. Same is true for natural gas. All of these things take multiple years to find new resources, then to produce them, right? And if you haven't been doing it for 20 or 30 years, you're going to have enough oil rigs to go and do this, etc. So of course, like now they're telling us oil demand is going to last longer and stronger than consensus, with no credible forecast calling for a peak within 8 years. And they're saying after that, demand will plateau, but it's not really clear to me, having looked at the data, that that's even true. Then they go on to say, outlook for natural gas demand is extremely strong, forecast to grow by 32%. The last thing I'll say about this before getting into, let's see, what do I have here? Yeah, let's share some of this again. Again, this is more analysis if you want to see. Talking about, this is from a report. I think it's from the IEA. And now they're telling us that most of the demand that has come online recently essentially just replaces, the stuff that's gone before. And now they're telling us, okay, in the absence of investment, supply falls so quickly. Bottom line, right, to this is that we need a lot more energy. We need and then we're just beginning to walk away from essentially what was an ideologically driven forecast to an actual reality-based forecast, which says we need more oil, we need no natural gas. And one of the shockers, for me anyway, was to find this, which is that coal, old school coal, right? I mean, McKinsey, right, which projected that demand by 2035 would be down by 40%. Now says it's going to be up by 1%. -40 versus, maybe it doesn't seem like such a big deal. Take my word for it. This is like night and day, right? In other words, they essentially pulled the wool over our eyes with respect to conventional energy demand. And as a result, everyone, private companies, governments, etc., all set their policies by it. Bottom line, we simply don't have enough energy of any kind. I'll go back to this tweet, which is this, the top line. The world needs all forms of energy, including, coal. Now people say, Paul, it's this, it's that. Hey, you don't like it, don't invest in it, right? But everybody wants their AI, everybody wants their devices, everybody wants their air conditioning. You want all that? Well, it all comes from some form of energy. Energy is one of the places where it's the opposite of tech, right? The prices are low, the valuations are cheap, and this is where, in my judgment, right, the expectations are low, where as new, again, demand, both for the energy source and for the stocks that represent it come in, these stocks will move higher. And I haven't even really mentioned sort of like the cherry on top, which is that the United States, Western Europe, and Japan, we are reindustrializing. After giving away our industrial base to China for 30 plus years, we're like, oh, yeah, that was probably not such a great idea. Well, what is it going to take to reindustrialize? Also, lots and lots of energy. Okay, moving on to the next one. And I won't spend a lot of time on this because my colleague Dan actually wrote the Substack, and he also made a YouTube video on this. Japan. All right. I won't spend a great deal of time on it. Please go subscribe to our Substack, which is ATG Digital with Paul Mampilli right there. And it will give you details. We just added 2 industrial stocks to the Japanese portfolios, sort of like set across our various tiers. But why Japan? Right? Why Japan? Well, essentially it comes down to the same thing. Low valuations. The Japanese stock market is by far the cheapest stock market by valuation around the world. Why? Well, essentially, it stood still for something like 30 years or so. And in the meantime, it's not like those companies were standing still. They were doing things to increase value, doing things to increase their efficiency. And now we're in a scenario where they've got capabilities that a lot of the world doesn't have. Like Japan kept, more of its industrial base relative to the size of its economy than many others, including Western Europe. So those companies, they're starting to see demand, and they're seeing a pipeline of demand that is going to continue for decades to come. So low valuations, low expectations, low prices, and also importantly, relative to the U.S. market, low leverage. Right? I mean, you do not see, the kind of leverage that we have in U.S. markets. So in our opinion, Japan is the place you want to go. Next, from there, I'll start with what's going on with sort of like interest rates, if you will. The blue line here is the 10-year bond yield. The red line is short-term yields, which more or less, is a proxy for what the Federal Reserve's interest rates are. And this is for 2025. So you'll see that short-term interest rates, which is the red line, are come down a great deal. So that's on the left-hand side. So the high for short-term interest rates was around 4.7, 4.8%, and we are down nearly, we're at 3.8% or so, which you can't really tell from this chart. long-term interest rates, I'm going to use 10-year as a long-term, they've gone down, but you'll notice that they've not, like you can see the dramatic drop here in the red line for short-term interest rates. But long-term interest rates, they're hovering sort of like, between what, 4.25%. Why? Well, because the market doesn't believe that inflation is under control, and everyone can understand why. We have shifted the goalposts from where 2% was this like line in the sand, where if you had 2% of inflation, central banks would not cut interest rates. And we have shifted the goalposts. It's not that 2% is some magical number proven with like perfect mathematics. It's just a number that they plucked out. But nonetheless, the world has depended on this 2% number. As I put it in last week's YouTube, if you're saving your money in cash, if you're saving your money using U.S. Treasury bonds, and the goalposts move from 2% to 4%, that's a doubling in the loss of value. That's material. And not only that, the goalposts might move even further. We might go to be like, well, we're willing to tolerate 5%. We're willing to tolerate 6%. Maybe in 10 years, we're willing to tolerate 10 or 12%. Yeah, 10% a year of your money losing value. Yeah, not such a happy outcome. The orange line again comes back to the issue of expectations, which is a volatility, right? I mean, this MOVE index measures the volatility in the Treasury index, and you can see, just like the stock market, there's been very little volatility in the Treasury market either. And so, bottom line, markets across the board, including crypto, which we're going to get to next, were really positioned to fall. And yeah, I mean, it could have been any piece of news that could have caused it. Yeah, in this case, it's a President Trump tariff tweet, but it could have been anything. That's my experience, and that's my, based on, I remember in 2000, the peak of the market, I think the government denied a deal between General Electric and I think it was Honeywell. And people said, oh, if they had agreed to the deal, the market would have. At that point, it was in the same conditions, right? I mean, there was an enormous amount of leverage. Valuations were crazy high. Prices were crazy high. Huge leverage, huge speculation. That's the issue, right? I'm just going to turn a little bit here to crypto. And orange, of course, here in this case is Bitcoin. Gold is gold. And then we have the red line, which is short-term interest rates, because that is important for liquidity. And then we've also got the 10-year bond. Why the 10-year bond? Well, because until I'll say about 2021 or so, the 10-year bond was seen as, along with cash, because people were worried about deflation more than inflation, as the store of value. Like anytime there was a market panic, U.S. Treasury bond prices would rocket higher, would surge higher. And that was just this trade that you could go to all the time. No longer. I mean, people are worried about inflation. And so today, people are still buying Treasury bonds as a store of value, but they're much more nervous about it. And there's increasing amounts of money that is now traveling into gold and into Bitcoin. Now, I know in the comments, people are like, but Paul, Bitcoin crashed. Did you not see that? How can you present this idiotic analysis? All right, listen, one day doesn't make a market, and, a market is made more than one day. I will say, the large money, the big money, right? Which is what today? Well, that's, there's 150 billion in the Bitcoin ETFs. I can't remember. There's another 100 or so million in the Bitcoin treasury companies. I think there's $60 billion across various countries. They are seeing Bitcoin in a different way than the average speculator in the United States. The average speculator in the United States sees Bitcoin as, let's call NASDAQ times 5, right? In other words, it's a speculation. I want in, I want to make big money. I want to make it today. And, if it drops 10%, I'm out. That is not the institutional view. They are seeing it as digital gold. And my view is that the recovery in Bitcoin will be quick, will be rapid. And if anything, this crash will actually shift the market even more over to the institutional sides. In other words, it is the retail side that is using perpetual futures. I mean, that's the cause of the crash. There are these things called perpetual futures. It's only there in crypto, where you can buy futures that are 50x, 100x, maybe there's even 200x. In other words, if Bitcoin moves $1, you're making $50, you're making $100, $200. And so as the prices move up, retail investors will load up on these perpetual futures. And then, of course, market positioning again, something happens, liquidity gets pulled out. Yeah, you have, where it goes from 125 to 105 in the space of a few minutes. It's not a particular shock. That is a reflection of the way that the market was positioned at this time. However, my view is that these lower prices are actually going to be scooped up by institutional investors, and then that is going to essentially be out of the market for the foreseeable future, because they are seeing it as a store of value, a hedge against inflation, a hedge against financial chaos, and a hedge generally against the current fiat-based financial system, which I think, long term is on its way out. And I'll do a YouTube video in the coming weeks talking about that. Okay, I'm at minute 36, so we got to get going here. Next up, let's talk about Fannie Mae and Freddie Mac, right? This is another place that I would be. Well, I didn't hit the bottom line with the crypto, which is that I would be a buyer of crypto as well. So 3 places to buy: energy, Japan, and crypto. And if you're looking for those ideas, atgdigital.media is where you can go. There'll be links, I'm sure, in the description below. All right, let's deal with Fannie Mae and Freddie Mac, which is that over the weekend, President Trump put out this post on social media suggesting that Fannie Mae and Freddie Mac will be worth $1 trillion. So $1 trillion. I mean, I asked Grok AI what the market capitalization of Fannie Mae was at the peak, which was actually all the way back in 1999 or 2000. It didn't make a new high in 2007. So the market capitalization was a little bit under $100 billion. So if President Trump is putting out there, right, that these two companies are worth about $1 trillion, I would very roughly then put Fannie Mae as being worth 60% of that, and Freddie Mac being 40% of that. And you can move those numbers 5% one way or the other. That's quite a bit higher than what I imagined. And I threw out, okay, I'll get to that. But the other news about Fannie Mae and Freddie Mac that matters is that it looks like they're going to sell 3%. 3%. I mean, yeah, 3% of, okay, 1 trillion, that's still, a decent amount of money that's got to be sucked out of the markets. But I think, there's enough liquidity, there's enough money to buy that 3%. I mean, remember, the government theoretically owns 79.99%, 80%, and they're only going to part with 3% right now. Yeah, these things start, rocketing higher. There'll be huge demand for this. At 3%, some of the numbers that I had previously put down. Let me just. I had previously put down, that the pricing territory was between 25-ish and 40, and I'm using Fannie Mae as a proxy for both companies. I'd have to say it's higher. If they're only going to sell 3%, I'm thinking, definitely on the higher side, maybe between 40 and 50. But either way, I would expect this news to start to move Fannie Mae and Freddie Mac prices higher. I've long theorized, maybe dreamed, maybe fantasized of the reverse waterfall. In other words, a scenario where what happened in 2008 kind of reverses itself. And I really have often been mocked on social media for talking about Fannie Mae this way. However, you can go back. I've been making videos about this for, I think, 5 years, right? So, hey, President Trump, bring it on, right? Let's do $1 trillion. Keep it to 3%, because if it's 3%, I think we're going to have the reverse waterfall. I mean, I will say, like, I mean, I always like to check and see, like, I have a reality check always for Fannie Mae and Freddie Mac. I always check this junior preferred security. If you don't know what the junior preferreds are versus the common stock, I'm not going to explain it. Watch some previous videos, Google, social media, you'll see. And one of the things is that even as Fannie Mae went from it's about 16 down to 12, the junior preferred, this is the most liquid one out there, has barely budged. In other words, the people who own this, they're like, yeah, no, this is a kind of done deal. Remember, the junior preferreds are capped at par, either at 25 or at 50, unless they also, as part of this IPO, say, well, you're not going to get your money back. Instead, we'll issue you common shares. And in that scenario, maybe they go over par. We don't know. We will find out soon. All right. That is a very, very, very rapid sort of roundup of what happened Friday, what, in my opinion, caused it, leverage, positioning, general high expectations market, peaking, topping style market, where you've got, very high valuations, very high prices, very high expectations. Then, we talked about where to invest, if, I think the vast majority of social media will say, go buy tech, go buy AI mania, go buy, all the high expectation things, nuclear tech, et cetera, et cetera. We will say, no, go conventional energy, oil, natural gas, coal even. Yeah. And we have coal stocks at ATG Digital. We just had it. One of them just rocketed straight up 50%. Japan, we'll tell you, is a place that has the opposite: low valuations, low prices, low expectations, low leverage. Crypto, because why? Well, we've shifted the goalposts on inflation, and people are looking for, stores of value. Like, no, we're not going to leave as much money in cash or treasury bonds. We want some other place. And then, hey, President Trump, yeah, he's, I think it's going to be a pump, for Fannie Mae come Monday. And then the IPO comes, and if they're going to sell 3%, yeah, some of the numbers that I thought were crazy that people were putting out there, maybe they're not so crazy. Plug for where you can get more on all of these, atgdigital.media. That's it. Thank you for attending Investment Tuesday. This is Paul saying goodbye.